We know the yield curve has predicted most of the recessions of the last century. Now I want to talk about why. Inversion just means that short-term securities, short-term bonds, are paying higher interest rates than longer-term securities. Why is it out of character for that to be the case? Time value of money is one of the most important and first lessons of finance, and it boils down to this. $100 today is better and worth more than $100 3 months in the future. So for example, I come to you and I want to borrow your $100 for 3 months. Now, when I borrow that money, I'm depriving you of the utility of whatever it is that you would buy right now if I weren't using that money. And so you may take this deal, but it's going to cost me. I'm not only going to have to return the $100 at the end of 3 months, I'm going to have to give you a little something extra. And that little something extra is what we call interest. Interest compensates the lender for the utility that they're giving up by not spending their money right now. And through interest, bond markets and credit markets are basically putting a price on time itself. Or they're trying to figure out what the price of time is. Okay, now we take this a step further. If money now is more valuable than money in 3 months, then money in 3 months is most certainly going to be more valuable than money in 10 years. And so if you're willing to lend me money for 3 months at 4.3%, let's say, then you're probably going to charge a higher rate to lend the same money to me for 10 years, maybe 5% or so. So the typical relationship is for long-term money, like 10 years, to pay a higher interest rate than short-term money, like 3 months. And when we talk about the yield curve, we're specifically talking about money invested in U.S. Treasury securities, U.S. Treasury bonds, effectively money lent to the U.S. government. Here's a chart of that difference in yields from 1959 to present. Over that time, this difference averaged about 1.5%. So that's why it's out of character economically for yields to be inverted. So now why does it happen? In the example we've been using, the yield curve is just the result of a subtraction problem. Take the 10-year yield minus the 3-month yield. Now, if left up to the forces of supply and demand for credit, you'd probably only see inverted yields during times of financial panics when short-term money is in extremely short supply. But yields are not determined organically by the supply and demand for credit. So ever since the advent of rate-setting policies, first by the Bank of Amsterdam in the 1680s and the Bank of England in the 1690s, short-term interest rates have been heavily influenced by the decisions of central banks. Back to the present, does the Federal Reserve directly control the 3-month Treasury yield? And no, they don't. But the thing about interest rate markets is that there are absolutely no walls between them. The Fed does control the overnight rate by which U.S. banks lend to each other, and that rate spills out into other rates. And here's how. Investors in the Eurodollar futures market are actually betting on what overnight rates are going to look like 3 months from now, all the way out to several years from now. Investors in 3-month Treasury bonds have to anticipate what overnight rates are going to look like over the next 3 months. Investors in 10-year Treasury bonds have to anticipate what 3-month rates are going to look like over the next 10 years. Now, I've just portrayed these different markets as if they're traded by different people, but in fact, there's a lot of overlap in the companies and institutions that are trading them. So thinking about it from that perspective, it's no coincidence that this yield curve inversion thing tends to happen whenever the central bank is raising rates. In 1919, the Fed raised rates in order to combat the post-World War I inflation and inverted the yield curve. In 1927, the Fed raised rates to combat over-speculation in financial markets and inverted the yield curve. In 2018, the Fed was in its third year of raising rates in order to normalize monetary policy and inverted the yield curve. In 2022, the Fed raised rates by 4% in order to combat inflation and inverted the yield curve. This is pretty much how it's gone down with each and every cycle over the last century. What is the connection between this bond market stuff over here and the macroeconomy? Ever since the development of modern banking, also a 17th century thing, the big driver of economic activity has been the creation of credit. And when we say creation of credit, we basically just mean lending, and there are a lot of types of institutions that do that. For 300 years, we've had banks in the modern sense. In the late 19th and early 20th centuries, we had things called trust companies. Later on, we got savings and loans. Now we have everything from bond dealers, mortgage lenders, auto finance companies, and investment banks. So there are many differences between these businesses, but they all have one thing in common. They make their money by borrowing short and lending long. In other words, a financial institution pays the short end of the yield curve and earns the long end of the yield curve. What that means is that a positive and large spread incentivizes credit creation. Investment and consumption spending in the real economy goes up, economic activity goes up. We call that expansion. A squeeze on that spread incentivizes credit destruction. Economic activity goes down, and we call that a recession. Now, congratulations. If you understood all that, you know more about the relationships between interest rates, credit, and economic cycles than I did after multiple years in undergrad and graduate level macroeconomics courses. And you know what? You know it for a lot less money. So good job, and I'll see you next time.